Tidbits from a mild-mannered accountant. Managing your creditors. You rely on good relations with creditors for the smooth operation of your business. Suppliers, the bank and statutory bodies such as the Australian Tax Office will affect the cash flow of most businesses. When your cash flow is tight, you may not be able to pay your bills on time. If you manage the situation well, your creditors will have more trust and confidence in you than before. But managed badly, the situation can develop into a crisis. Let's take a look at how you can best manage your trade creditors. 1. Your payment policy. A well thought out payment policy is a vital part of building a strong and trusting relationship with your suppliers and other creditors. A. For every supplier, work out what your purchasing objectives are. The priority is usually reliability, followed by quality, price, and then credit terms. Shop around. If you have a choice of good suppliers for a particular product, your supplier may be prepared to extend the credit period to keep your business. B. Set out a general policy on payment and make sure your suppliers understand your payment terms. For example, you might pay within 30 days of receipt of invoice. If you generate cash, like most retailers tend to, you can afford to pay quickly in return for price or settlement discounts. Write down your terms of trade and ask any new supplier to agree them by writing and returning them. If the supplier's terms of trade conflicts with yours, come to a written agreement before you order. If you manage your cash flow well, you should be able to pay your suppliers on time. C. Allow for some flexibility. Be prepared to trade off credit in return for other concessions, or vice versa, from your suppliers. Some suppliers operate on a cash upfront basis or require a deposit. D. Communicate the benefits to your supplier so they can support you in the future. If you pay promptly, your supplier should expect to do a favour in return when you need one. If you negotiate extra credit, show the suppliers what they get in return. E. Review your terms regularly. Check whether other suppliers would offer better terms. If they would, ask your existing suppliers to improve theirs. 2. Key creditors. Identify which creditors are vital to the survival and growth of your group business, then work out tactics to win the support of each one. A. Your financial backers are usually top of the list. Treat your banker as an investor by providing regular management accounts in a format which the bank has agreed is useful. Make sure you are aware of what would happen if you were unable to make a payment on time. For example, at what point would your hire purchase company repossess the equipment? B. Decide which suppliers are critical to the business. IT suppliers, who regularly maintain your IT system, are often high on the list, as trying out a new supplier can be a risk in itself. Your landlord may have the right to evict you for non-payment at short notice, but your landlord would have the right to seize goods within your premises without going to court. Suppliers of commodities which you can buy elsewhere are at the bottom of the list. C. Identify which creditors are likely to be inflexible. Statutory bodies such as the ATO can automatically charge interest for late payment. Your local council can sue you for non-payment of business rates. Utilities suppliers can cut off your telephone, electricity, water or gas. One problem is that these organisations are large and impersonal, so it's hard to build a supplier relationship. If you hold back payment because of a dispute, you may be penalised immediately. You may have to pay up first and argue your case afterwards. If you're worried about being able to make payments to the ATO, such as tax, employee super or BAS payments, staff can review your circumstances and discuss temporary measures such as arranging for payments to be made over a longer period. 3. Building a relationship. Will a supplier go the extra mile for you when you need a rush delivery or extend credit? A. Negotiate clear written agreements at the outset, then stick to them. Be aware of suppliers' right to interest or late payments. B. Involve your suppliers in your business so that they understand your needs. Suppliers are often good at coming up with ideas for how to improve your product or your whole business, as they supply other companies like your own. C. Keep them informed to build up their trust in you. A common example is the situation where you withhold payment because you received damaged goods. It's not enough to telephone the operational manager at the supplier to explain the situation. You should confirm it in writing and copy the letter to the managing director or finance director there. Otherwise, when they review the aged debtors list, they will assume that you have simply refused or are unable to pay on time. Also, keep informed about developments at your suppliers. For example, a change of ownership can mean a drastic reduction in the credit a supplier extends to you. D. Ask for benefits in return for giving suppliers what they want. For example, you might negotiate to receive an enhanced service in return for committing to place regular orders or pay on shorter terms. 4. Your bank. If you are going through a cash flow crisis, you need your bank more than ever. If your bank is financially exposed, this is the exact time when the bank is most likely to reduce its financial support for you. A. Identify who the real decision maker is at the bank. More and more lending decisions are made on the basis of computer-generated risk profiles. This leaves local managers with less decision-making power. You need a champion in the bank who knows your business and who will listen to when decisions are being made. B. Build up a track record. Supply the bank with regular management accounts, including cash flow forecasts and a brief commentary explaining variances. Be proactive rather than waiting to be asked for the information. C. Give advance warning to the bank of any cash shortages. The earlier your warning, the more support you may receive in return. Provide evidence to show that the cash shortage is only temporary. Third-party evidence, such as a confirmed order, can be particularly effective. D. Shop around, so you have options ready for when you need them. Even if you expect to remain a loyal customer, find out what is on offer from other banks and alternative sources of finance. This will enable you to negotiate better terms, and you can win the bank's respect in the process. In principle, the bank can demand repayment of an overdraft at any time. Consider the benefits of alternatives such as bank loans, leasing, hire purchase and factoring. In smaller businesses, personal finance is increasingly a major source of funding as well. Banks have been known to reduce borrowing facility as a direct result of the business in financial difficulties asking for it to be extended. Providing the right information in the first place is the best way of ensuring that this doesn't happen. 5. Business Activity Statements, or BAS. The ATO has a reputation for rarely tolerating unnecessary delays in the payments due to it. Paying BAS late or making any mistakes in your BAS can be costly. A. If you need time to pay, approach the ATO with a clear payment plan. Unless you have clear evidence that the plan is reasonable and viable, it is unlikely to be accepted. You are far more likely to be granted a temporary arrangement to pay, such as paying off the debt monthly over 3 months, than a longer-term arrangement. If you fail to stick to the agreement, you can be penalised and are less likely to be granted other arrangements thereafter. B. If you repeatedly fail to pay the BAS on time, the penalties can escalate rapidly. 6. Financial difficulties. A. If you are in financial difficulties or expect to be, get professional advice quickly. Consult a reputable firm of insolvency practitioners. Directors who allow their limited company to continue trading with no reasonable prospect of avoiding insolvent liquidation may be personally liable for insolvent trading. They also run the risk of making preferential payments. For example, If you paid back a director's loan in preference to paying a trade creditor, this would probably be a preference, in which case the money would have to be repaid. Assuming that you are not advised to cease trading, take steps to improve your cash flow. B. Agree extended credit with your suppliers. The further ahead you can plan this, the better. Reassure your suppliers that the problem is only temporary. For example, you might explain that you are taking on a large order which will cause a hole in your cash flow in 4 months' time. Or you might be recruiting and training a new salesman, which will reduce sales in the short term but will boost sales thereafter. Agree a plan, then stick to it. Don't be too optimistic. You will probably be advised to part pay several creditors rather than paying one and ignoring the rest. Aim to achieve some visible progress in the eyes of all the creditors. This will help you buy time to trade your way out of difficulty. C. Keep your bankers informed to avoid any panic at their end. If you have not done so already, investigate the scope for extending your borrowings. D. If you receive any demand notices, immediately ask your solicitor how to proceed. Free, with a sting attached. Many businesses help themselves to credit from their suppliers, far in excess of the terms they were agreed. Because trade credit is usually interest-free, there's a temptation to abuse it. Asking for extra credit from a supplier is fine, and most suppliers will support you. But helping yourself to extra credit shows that you are untrustworthy, that you disregard the supplier's own cash flow needs, and perhaps that your business is in financial difficulties. Creditor rankings. In the case of insolvency, creditors are paid in the order below. A. Secured creditors, with a fixed charge on assets such as property and machinery. Most bank finance is secured with a fixed charge and or a floating charge. If you fail to make payments on time, the creditor has the right to have the assets sold to cover all or part of the debt. B. Preferential creditors. These are employees, which are now the main preferential creditors for holiday pay, accrued wages, and contributions to superannuation. C. Secured creditors with a floating charge on assets such as stock and work in progress. And D. Unsecured creditors, which includes most other trade creditors and the Australian Tax Office. Stay tuned now for more tidbits from a mild-mannered accountant.